makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha, Qatar. We're here for the Qatar Economic Forum, which kicks off tomorrow. Now, here's what's coming up on today's program. President Biden is set to quadruple tariffs on Chinese EVs and sharply increase levies on other key industries as Washington's trade battle with Beijing actually intensifies. The Russian President Vladimir Putin replaces his long-serving defense minister, an unexpected changing of the guard more than 2 years into Moscow's invasion of Ukraine. And Emmanuel Macron's Choose France event is taking place today. Microsoft, Amazon, and others are set to unveil major investments. The French president will also join Bloomberg TV for an exclusive conversation a little bit later on today. Now, first thing is first, we have a lot of news to cover, but let's take a look at the European markets map. Now, I came in this morning and the first thing I read was actually a brilliant John Author's piece saying, welcome to inflation week, because today, if you look at Europe, but also across the board, stocks are taking a little bit of a breather as investors are really waiting some key data this week that may cast light on the outlook for interest rates on both sides of the Atlantic. But the main focus will, of course, be on the U.S. Consumer price numbers due on Wednesday, after data last week pointed to an economy that is slowing amid some stubborn inflation. So let's do cross assets. We're always looking at treasuries to have a look at how some of these traders are positioning ahead of a big week when it comes to data. Look, first quarter GDP and unemployment data for the Euro region are also due out on Wednesday. So it's going to be a big week on Wednesday. You can see sterling on the back of the BOE last week, 125.22. And then a couple of other things I'd watch out for is we also had news from China that the country will sell ultra-long special bonds, and that's boosting sentiment after weak data from, of course, China over the weekend. So the Biden administration set to quadruple tariffs on Chinese electric vehicles and sharply increase levies for other key industries. Now, Bloomberg understands that EV tariffs will rise from just over 27% to more than 100%. Now, for more on all of this, we're joined by Craig Trudell, Bloomberg's Global Autos editor. Craig, thank you for joining us. I mean, this seems political theater. Is this trying to get votes in the U.S.? What does it actually mean in terms of Chinese EVs getting into the U.S.?
Yeah, this is a case of mostly symbolism of the fact that EVs, we have not seen a whole lot of Chinese electric vehicles make it into the U.S. Because, for that matter, the fact that the Trump administration, as you mentioned, had already increased tariffs on vehicles from China to 27.5%. So, I mean, that was really enough already to make a significant, sort of send a significant message that your vehicles are not welcome here. I do think that there was, by some measures, an ability to import into the U.S. and still be able to sort of, take that hit. We now see, that small gap completely closing. I think the level of sort of unity in Washington, it's the one thing that's sort of unifying both parties is really taking a tough stance on China, particularly with important industries like the car industry.
Craig, it feels like, or we had news that some may actually be exempt. I don't know if those are panels or anything like that, or it's just too soon to say. But how did Donald Trump react to the news over the weekend? Would he do more tariffs against EVs?
He was mocking. He said, isn't this nice? And referred to this idea of actually, this view that Biden should have done this years ago. I think that's interesting in light of the fact that, Biden kept in place Trump-era tariffs. I do think also he's been really hitting this idea of a possibility of Chinese manufacturers building in Mexico and sort of using Mexico as a sort of backdoor. And we've seen indications in recent months that while there was some interest among companies to do that, that essentially Mexico has kind of shut out Chinese manufacturers to some degree. So while he's talked about, taking Biden's 100% roughly rate and saying, I'm going to put 200% on cars coming in from Mexico, that's extremely theoretical. There's not any actual Chinese electric vehicle plants going up in Mexico and trying to import into the U.S. So this is very much, political theater and in keeping, with this announcement from the Biden administration being largely symbolic and sort of carving out, a tough stance.
But Craig, because overall, if you look at the supply of some of the EVs, but also aluminium, steel, and some of the other things that the administration has put tariffs on, it's very small. So it's not really about crushing the segment, right? Is it about delaying the entry into the U.S. market?
Yeah, I don't think that we're going to see Chinese, cars just making it into the U.S. generally. I think, even with respect to, if you were able to overcome a tariff rate as high as where Biden wants to take it, which, is quite difficult to do. So I think, there's even, moves to try and kind of turn this into a national security issue. And the fact that, electric vehicles tend to have, cameras for crash avoidance systems and sort of on those grounds blocking electric vehicles. So I think we're going to see, this become, an example of the ways in which the world is very much bifurcating as, China versus the rest of the world and what's acceptable to various markets.
Craig, as always, thank you so much. Craig Trudell there, Bloomberg's Global Autos editor. Now, we'll have some really good interviews a little bit later on. We'll also hear more about the state of the U.S.-China relations and China's overcapacity issues from the U.S. Treasury Secretary Janet Yellen's exclusive interview with Bloomberg TV and radio is coming up a little bit later. Now, let's go to the markets with, again, a big week. It's inflation week. We also have tariffs and the like. We're joined by Trevor Greetham, Royal London Asset Management's head of multi-asset, and Bloomberg's Justina Lee. So thank you both for joining us. Trevor, let's start with you. It's inflation week, happy inflation week. How important are all those numbers coming from the U.S. to try and give us a glimpse of what happens to Fed's monetary policy?
Absolutely critical. At the moment, you've got the markets facing a bit of a summer tightrope where normally in the summer the markets get more volatile, there's thin trading, people get very sort of anxious. And with inflation where it is right now, and with the Fed where it is right now, if you've got really strong economic activity over the summer, people would worry about rate hikes. And if you've got weak economic activity, people would worry about earnings. So what you really need to square the circle there is inflation to come in lower than expected so the Fed can cut rates, even if growth holds up. You don't want to say, good news, the Fed's cutting, bad news, the stock market's falling.
So what does that tell us, Justine, about what the markets are looking for? Again, we know these set of numbers are extremely important, especially the nuances that we've seen and dangers about the U.S. economy overheating. But are we going to see positioning in treasuries, but even something like gold ahead of the Wednesday CPI?
Yeah, I think those are some really important questions here, because if we look at what's been going on in the Treasury market, I mean, yields have fallen quite a bit, with markets generally relieved that it doesn't seem like we're going to get another rate hike. But I think these numbers are really critical in the sense that, I mean, economists are expecting CPI to be generally like a tad kind of lower. But at the same time, we've kind of seen these contradictory signals. On one hand, the labor market has seemingly been slowing. But at the same time, I mean, if you look at the inflationary indicators, I mean, those don't seem to be cooling at all. I mean, so how do we kind of reconcile that? Or could it be that a lot of the factors swaying inflation right now are just no longer related to the labor market?
Yeah, and Trevor, I think you're maybe one of the lonely voices putting out there. I think Larry Summers is saying that we could see a rate hike. Why has that been largely discounted? I mean, the mood of the markets is very clearly towards optimism that inflation has been tamed. So I don't know whether it's because the Fed overpromised in December and there's still the overhang of that, or whether the market is looking at a different set of numbers.
Well, I mean, if you look at the U.S. economy, it's posted solid growth, really, throughout the last 3 or 4 years, and against expectations. People were expecting, after the pandemic, the interest rate shock, to see a recession. It hasn't happened because you've had a kind of rolling series of sectoral recessions. First of all, services, and then production and housing. And what you're seeing at the moment is services are still strong, and production looks like it's recovering. And that could result in stronger activity, sticky inflation, and Fed rate hikes. I mean, certainly I would not rule that out. I do think the Fed wants to squeeze in a rate cut if they can. Don't expect a big series of rate cuts, though, unless you get a lot more weakness in the economy. If you look at the U.S. unemployment rate, it's starting to trend higher. You have to squint your eyes a little bit, but it's still a very low unemployment rate, and that does create inflation risks in the labour market. And you've got a whole range of other, what we call spikeflation shocks out there, things like geopolitics, net zero, deglobalization. All of these things can result in one-off shocks to the price level, and that's what could bring inflation back. So I think the Fed doesn't want to kind of ease too soon and find themselves having to hike aggressively later, and that does limit the scope for rate cuts. We've been overweight stocks, underweight government bonds all year. We haven't changed that position. And I think the real sort of tightrope, as I referred to earlier, is that the way to get the Fed definitively to cut rates is unemployment rates to rise. And can the stock market weather that without wobbling?
Yeah, but, and there's a number of problems, right, in all of this, because it's a set of data that doesn't always match what we've seen, and this could be because of where we are in the cycle, or just the fact that this is a different cycle. But we also need to factor the fact that, you know, the rising interest rates could have a lagging effect and could start impacting the economy. We know that the Fed, certainly Jay Powell likes the University of Michigan numbers, and if you look at expectations and assessment of current conditions, they're both dropping a little bit, Trevor. So what do you do with that number?
It's very mixed data, both on the inflation side, where you would expect inflation to start to kind of ease, and it might be sticky on the way down, but you would expect inflation to drop. I see more scope for that at the moment in Europe than in the US. On the other hand, the growth picture is a bit mixed as well. You've got some contradictory signals from things like consumer confidence, and the bit of the cycle that looked like it was accelerating 2 or 3 months ago, which was production. The more recent data from the purchasing manager surveys suggests that maybe that's actually petering out as well. So it's a really tricky one right now. And I think what it says is central banks are on hold. And when things become clearer, they'll be hiking or they'll be cutting. But hikes are definitely possible if the economies just stabilize from here and production picks up. I think rate hikes are possible.
Justina, I mean, to Trevor's point, I mean, it does seem like we're in a fine balance, almost like a fine balance like we haven't had in the past. Is that fair? And what does it mean for money moving around right now?
Yeah, I mean, you raised a great point, which is obviously the question everyone's always asking is, are we going to see kind of a lagging effect with monetary policy, and that we're just going to be shocked kind of one day and seeing the effects feed through? You know, for instance, one factor in inflation that a lot of people are talking about is those high rents in the U.S., which just seem so sticky. But of course, that kind of tends to react a bit more slowly in that it doesn't really move until, you know, people kind of move around or they renegotiate their leases. And so that's sort of in the camp of, you know, maybe inflation looks sticky right now, but it should be coming down. And I think that kind of will have a lot of implications, you know, for currencies. For instance, we've seen the strong dollar for quite a while now, and also for equities, which kind of have been surfing this like Goldilocks environment.
Okay, thank you both for joining us. Justina Lee, of course, from Bloomberg, and Trevor Greetham from Royal London Asset Management stays with us. Now, coming up, we'll have plenty more from Qatar, Doha, much more. This is Bloomberg. Welcome back, everyone. Now let's return to our discussion with Trevor Greetham from Royal London Asset Management. Trevor, thank you so much for sticking around. Now, we're talking before about, I guess, the dispersion or the fact that you have different kind of data points, and it's quite difficult to put them all as one. There's also extreme division in politics, especially in the U.S. Does it make it harder to understand what kind of economy you're dealing with? Does it seep through economists' expectations?
I think it will do. If you think about other polarized debates, like the Brexit debate in the UK, for example, one side looks for every bit of data to prove that Brexit's disastrous. The other side looks at every bit of data to say everything's fine. And economics isn't a perfect science. So you will get people interpreting the data in the US in the run-up to November's election the way they want to see it. But I'm just struck by the fact, do you remember the inauguration speech from Trump when he became president was all about, you know, the wasteland of the American economy. And people were looking at each other going, which American economy? Because at that time, the data was actually quite strong. So I think for Trump specifically, it won't matter. He'll just say everything's a disaster, even if it isn't. But the data's enough, and there's enough mixed data out there to give some credence to that view.
Trevor, there are a number of questions also if the Fed starts cutting, and same for the Bank of England. In previous cycles, we've always had, you start with a cut and then you continue cutting even if you're very tentative. This feels different. Do we have a blueprint or a manuscript for what could happen in terms of you cut once and then you wait?
It does feel different. You mentioned the lags of monetary policy earlier on, and there is a refinance wall out there, which could mean that you get, financial sector problems piling up, and therefore one rate cut becomes 5 rate cuts. But it feels like this is such a different business cycle because of COVID and the sectoral recessions, which didn't overlap. It feels like the economy's actually got some robustness to it. So I'm in the camp at the moment that says probably we'll get the Fed to cut rates if the data on Wednesday is soft. Maybe they'll cut rates sometime this year. But I don't see it as the beginning of like 8 rate cuts. I think it's more a steadying the tiller. And then when we're back in the same position we were before, which is trying to read the data, what's happening with inflation, where is it basing, and are there any more shocks coming down the pipe, which means inflation goes back up again. And what the Fed really doesn't want to do is get caught in that early 1980s situation where they cut rates aggressively and then have to hike them again. You get a double-dip recession. They don't want to do that.
Trevor, the other really interesting central bank is, of course, BOJ. We had news today that they were, cutting some of the bond buying. This is an irregular operation, but also yen again weaker. What can they do?
They can't do a lot, really, because everyone knows the inflation picture in Japan isn't that hot. It's very hard for them to suddenly come out and say this is the first of a series of rate hikes, or that we really mean it. So I think they're kind of in the lap of the gods, really. If the US economy is stronger than expected, the Fed doesn't cut very much or even starts hiking rates, then the yield spreads between the US and Japan will widen again and the yen will weaken again. Intervention doesn't really cut the mustard unless you have a policy shift going along with it. And everyone knows Japan can't hike rates aggressively at the moment. They don't need to. So I think the risk is that if you do get a stronger than expected US, the dollar strengthens, the yen weakens again, which is why Japanese equities for us are like an anti-bond play. If you're worried about treasuries, you think interest rates could go higher, Japanese equities are doing well in that environment because the exporters are benefiting from the weak yen. You do have to be careful about the yen exposure. So if you're buying a futures contract, you don't get the currency. You can buy an exchange-traded fund, for example, that's hedging the yen. But if you can get that exposure, it's like an anti-bond. And in the scenario where the Fed's hiking, it should do you well.
Interesting. Trevor, as always, thank you so much for joining us. That was Trevor Greetham from Royal London Asset Management. Now, coming up, we'll have plenty more on corporates. SoftBank reporting a second straight quarter of profitability. We'll have more on the AI boom that has buoyed assets, including chip designer ARM. This is Bloomberg. Welcome back, everyone. Now, Amazon, Microsoft, Pfizer, and Morgan Stanley are among the companies poised to boost their presence in France. Now, a flurry of new foreign investments will be unveiled today, amounting to almost 15 billion euros. Now, President Emmanuel Macron is hosting 180 chief executives this week in a push to re-industrialize France and make it a financial hub for the post-Brexit EU. Well, President Macron will speak exclusively to Bloomberg from the Choose France Summit. That interview with our very own John Micklethwaite, our editor-in-chief, and that's at 6 p.m. UK time. You don't want to miss it. The Goldman Sachs chief executive, David Solomon, will also join us for an exclusive interview as he takes part in the Choose France Summit. That conversation starts at 3:30 p.m. UK time. Now, onto SoftBank, and it's reported a second straight quarter of profitability. The Japanese tech giant has benefited from an AI investment boom, which has buoyed assets like ARM. Well, let's bring in Bloomberg's Alex Webb. Alex, what's your main takeaway from this? So is it the software earnings or the fact that now they're sitting on so much cash that we're just wondering what they'll do with it next?
Well, I think it shows you actually how dependent they are on ARM. Even though ARM has now been listed in the US, it remains consolidated within SoftBank's earnings. They still own considerably more than 50% of the equity. The question now, and this is the thing they're trying to play up is like how they benefit from this AI boom. ARM actually did pretty well at the end of the quarter, at the end of March, but actually since then they had slightly soft earnings and the share price has suffered as a consequence. People are sort of realizing with ARM that it's not quite the AI play that they would have you believe. Nikkei reported yesterday, in fact, that ARM is trying to have an AI product in the new year, but it's still very early stages in that, and there's a lot more they can do.
So how will their investments change, Alex? I know they've also wound down some of their investments. Do we have any, how are they going to take advantage of this change?
Yeah, I mean, it's really about trying to increase their exposure to AI. It's interesting, it's an interesting time to do it because we're presumably very much at the top of the cycle. The valuations in the AI space are pretty punchy, so how they get value there is interesting. The GraphCore deal, which has been reported that they're in talks to acquire GraphCore. Now, that is a company that designs chips specifically for AI. If they can make that happen at a knockdown price and the tech is good, that's a good on-ramp.
Alex, thanks so much. Alex Webb there from Bloomberg Originals. Coming up, we have a full roundup of news from the Middle East. This is Bloomberg. President Biden is set to quadruple tariffs on Chinese EVs and sharply increase levies on other key industries as Washington's trade battle with Beijing intensifies. Russian President Vladimir Putin replaces his long-serving defense minister on unexpected changing of the guard more than 2 years into Moscow's invasion of Ukraine. And Emmanuel Macron's Choose France event taking place today. Microsoft, Amazon and others are set to unveil major investments. The French president will join Bloomberg TV for an exclusive conversation later today. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha for Qatar Economic Forum. Now, the Russian President Vladimir Putin has replaced his long-serving defense minister with his former economy aide. Now, the surprise cabinet reshuffle signals a focus on growing the Russian economy more than 2 years after the invasion of Ukraine. Well, for more on all of this, let's go straight to Sylvia Westall, Bloomberg's managing editor for economy and government. Sylvia, thank you so much for joining us. Now, this comes a couple of days after President Putin was sworn in again. What does it tell us of how the economy and, of course, the war efforts will shift?
Sure. I mean, I think the reshuffle and the choices perhaps signal some displeasure from Putin at how the war has gone on. If you remember back to the start of the invasion of Ukraine, Russia boasted it would be over quite quickly. And obviously we're here, things are still grinding on the ground. And Russia's had to completely recalibrate its economy in response to the need for funding the war and also to adapt to these sweeping sanctions. And in some ways that's actually Russia's managed to do that quite effectively. If you look at now his pick of this close aide and a trained economist in this role, it does signal that there's sort of a focus now on how to keep this war economy going, how to make spending and other elements more efficient and able to have a kind of more sustainable front line as Russia pushes onwards in its invasion now in Ukraine.
So, Sylvia, what do we actually know about Andrey Belousov, this new defense minister? As you're saying, he's an economist by training. Is this more the purse guy, the money guy in the war efforts, and is it going to be less strategic than the previous defense minister?
Well, he's definitely not a military man. It's clear that, the military analysis and the way in which it's being formulated is very much being directed from the top with other individuals in Russia. He's seen more as someone that will bring in kind of efficiency to the spending and the ways in which things operate. I think perhaps the sort of surprise, it perhaps wasn't a surprise that Putin shook things up and that he replaced his former defense minister Shoigu, who had been kind of under pressure over the war. But what's quite interesting is this pick here, and we'll be finding out more about him. I think it does signal this sense that the economy is very much coming into focus, and that's also important in the lead up to Putin's trip to China, where he's obviously going to meet one of his most important allies in sustaining that war economy and the importance of trade with China that's kept Russia afloat in many ways.
Sylvia, thank you so much. As always, Sylvia Westall, there, Bloomberg's managing editor for the economy and government. Now, the U.S. Secretary of State, Antony Blinken, says Israel risks fueling Hamas insurgency in post-war Gaza. It's the latest warning in a steady escalation of U.S. concern about Israel's conduct in its fights against Hamas. Well, for more on all of this, we're joined by Leslie Vinjamuri, Director of the U.S. and Americas Program at Chatham House. Leslie, as always, thank you so much for joining us. It's unclear where this conflict ends and how many more loss of life there will be. Like, how do you see the next couple of months evolving?
Well, right now we're at a moment of urgency for those over 1 million Palestinians in Rafah. And the problem, as you rightly signaled, is that it's very difficult to think about the day after the plan for governance in Gaza when the world is facing such a critical moment. And we're seeing the U.S. begin to, at least at the level of the words that are chosen, put slightly more leverage on Israel, still demanding that the hostages be returned, that Hamas return those hostages, and trying quietly to continue those talks. But it seems to be at a standstill, with Netanyahu continuing to tell Palestinians to evacuate. And as we all know, from an area where there's really nowhere to go, where humanitarian assistance has been blocked. And so it is a crisis moment. And you know, Blinken and Biden are both getting it from all sides. Many people seeing the pressure on Israel to being very insignificant at best, having little, if any, impact. And, you know, to the extent to which those military weapons will really be held back is unclear. Some people think the report that came out was too, didn't really draw a hard enough line and chose its words too carefully. And others think that the right thing to do right now is to be quiet, to exercise quiet diplomacy, quiet pressure on Israel, because these overt words are simply playing into the hands of Hamas and other partners and other adversaries in the region. These are really complex decisions to make. I think the U.S. is trying to put pressure on all sides, but the reality is that those people on the ground, this is potentially a humanitarian crisis, a loss of life, unlike we have seen in many years in the Middle East, and it is truly extraordinary, Leslie, in its scale.
Are you surprised? I mean, the tone in which the U.S. is now talking about the conflict and warning Israel about what will happen if they really, you know, do the incursion into Rafah. I mean, it's a change of tone. Were you expecting this to come quicker? Can they go even harder? Or, as you seem to be intimating, this actually makes no difference and could be counterproductive?
Well, it is a change of tone. I think it's a change of tone that many people have wanted to see for a long time. We know that President Biden has been pursuing a strategy of holding Israel close. He believes in the state of Israel and its rightful, its right to provide for its own security, to get the hostages back, to defeat the threat that Hamas presents. But there's been a feeling and the signal from the administration that pressure on Israel has been quiet. It's been private. So the shift now is that it's in the public domain. But it's really, for many people, given the scale of the threat to the loss of life of Palestinians that is presented right now, it's simply too little. And many people are concerned that it could be too late. But again, the job of the U.S. right now, in part, is to put leverage and pressure on all sides, on Hamas, on Israel, and on other parties that have an ability to influence either of those two sides. And so it's a tricky, it's a tricky position. And as we know, Biden is facing pressure from all sides domestically in an election year where the Republican Party is, quite frankly, outraged at the words that Secretary Blinken and President Biden have chosen in recent days, and where we've seen what's happening across college campuses, where younger generations are really taking a different stand on Israel, wanting the U.S. administration to put more pressure on Israel to exercise restraint. But again, the real crisis is potentially and is in Gaza, and the administration also right now, I think, is trying, but many people feel, and probably not hard enough, as we can see, to get humanitarian supplies. That really is the urgency of the moment. The strategy and the need for a strategic resolution to the conflict really feels very far off right now.
Leslie, I also wanted to talk to you about these extra tariffs that President Biden is looking to impose on China. How much of this is symbolic and actually all about politics? Because a lot of these sectors, these targeted sectors, don't really rely on U.S. consumers, so they haven't really penetrated the U.S. market.
That's right. The U.S. is not importing electric vehicles at this point in time, and that is symbolic. But there's an effort, I think, also to affect prices beyond America's border. The administration has been, as I understand it, preparing these for a very long time, is trying to be very targeted and very careful in the way that it exercises them. It's clearly demonstrating that it will be tough on China and that it will focus very much on trying to give advantage to that part of the economy, especially the climate and renewable sector that the president has been trying to invest in through his climate plan, the Inflation Reduction Act. And of course, the fact that this is an election year really matters. But we expect to see an announcement of these tomorrow. Many of them are symbolic, but again, symbolism is important at a time like this. But there is a global market in which these tariffs are also being exercised.
So, Leslie, we're 6 months away from the election. I mean, is it about being different to President Trump, but at the same time making sure that actually, you know, that Trump cannot go after Biden on China? So what do they deliver? Like, what are the main differentiating points that we'll hear from, you know, both candidates over and over?
I think the Biden administration, yes, clearly believes in and wishes to be strong on China, but in a more measured and targeted way, saying, you know, and we've just seen, right? John Podesta has been negotiating and in talks with his Chinese counterpart to try and drive forward a positive agenda on cooperating, on reducing emissions, on the climate agenda, more specifically in the run-up to the next COP. So the administration, at some level, is doing what it always said it would do, which is to try and compete and cooperate with China, but it's doing in a tougher way. And the timing of this announcement clearly important for signaling not only at the national level generally to Americans that the Biden administration will take a tough stand on China, but also to domestic manufacturers that are seeking to invest in a targeted way in those areas that the administration is trying to create incentives as part of that green transformation. And this is really the area that differentiates the Biden administration from a potential second-term Trump administration, which is that focus on climate, both the positive agenda and the use of tariffs to try and move the needle on America's competitiveness, something that, you know, has a long way to go. And I think this administration is very aware of that.
Leslie, thank you so much. As always, Leslie Vinjamuri, the director of the U.S. and Americas program at Chatham House. Now, coming up, we'll have plenty more from the Middle East and from Doha. Ahead of the Qatar Economic Forum on Tuesday, we'll look at how the Gulf state is trying to broaden its economic and soft power across the globe. This is Bloomberg. Well, the Qatar Economic Forum, powered by Bloomberg, kicks off tomorrow here in Doha. The event will explore the issues driving global boardroom conversations and spotlight the Gulf's rising prominence. Now, 4 of the world's top 10 sovereign wealth funds are from the region. Their global investment portfolios now include American tech companies, English football clubs, and African mines, as they look to diversify beyond oil and gas to accumulate both hard and soft power. Now let's bring our chief emerging markets economist at Bloomberg Economics, Ziad Daoud. Ziad, thank you so much for joining us. First of all, if you look at Doha and Qatar, I mean, geopolitically, they're also a bit of a heavyweight as they do quite a lot of the negotiation between Israel, Hamas, and the West. How have they brokered this part?
Well, the views. I mean, basically, Qatar is an example that shows you don't need to be large as an economy or have a large population to have an influence and soft power. And yes, currently they are basically mediating between Hamas and Israel. They previously mediated between Taliban and the US. Potentially, maybe at some point, they'll also be in talks with Iran and so on. But that didn't start with the negotiations and mediation. I mean, back in the 1990s, before Qatar was extremely rich, they started Al Jazeera TV channel, which is extremely influential in the Arab world and still is, especially at times of war like the ones we're living in now. Qatar also hosted the World Cup in 2022, and that's another way to project soft power. So yes, it's currently using its wealth to punch above its weight and to mediate between global powers and regional conflicts. But that process has started a while ago, certainly in the mid-1990s, when it became more ambitious economically and politically.
So, Ziad, economically, again, this region is very oil rich, and part of their story is basically, the transition here in Qatar. It's also going into LNG, but what they invest for in the future. I know it's a lot of the conversations that we'll have here at the Qatar Economic Forum. You have a flight a short while from now from joining us. What's the one question that you're trying to figure out for the region as they transition into an oil-less economy?
Well, I think there's a couple of things here. The first thing is that diversification away from oil becomes less urgent when oil prices are high. And oil prices have been high after the pandemic. They averaged $99 in 2022, and they're currently around $83 today, which is, relative to history, is relatively high. So I see less of an urgency to diversify in the region, and definitely you see that in Qatar, which now plans to expand its LNG production by 85% by 2030. And I think the second question that is important here is, as the 6 GCC countries are trying to diversify away from oil and gas, they're essentially targeting the same sectors. So they're all targeting tourism, financial centers, logistics, and basically high tech and AI and IT. And you wonder if the region needs so many tourism centers and so many financial centers and so many mega airports and mega ports. So this crowding out within the region, the fact that they're targeting similar sectors given the similar economic structure, is another question I'd like to ask, and whether that different countries can approach different sectors differently rather than all hitting the same basically economic activities.
Ziad, what's also interesting is that because there's so many sovereign wealth funds with a lot of money, it's basically trying to figure out what they're putting their money in. And so that's sports, technology, and AI, which we'll also try and figure out here.
Yes, that's right. I mean, I think if you look at the GCC investments, and they've been vast, and they obviously with high oil prices that are accumulating a lot more, I think basically what they try to do is they try to do three things. They try to invest money in order to get an economic return that would replace oil revenues when they drop one day. So there's sort of the economic aspect to it. There is a soft power aspect to it, which is basically investing in the World Cup, investing in sports, investing in even rebranding. And we're seeing that in the case of Saudi Arabia, which is trying to move away from its old brand of a conservative country to a more open one. And the third aspect of it, you see the money also deployed towards political targets. And that's not new. There was a 1973 oil embargo that was using an economic power to achieve political targets. There was the bankrolling of the Iran-Iraq war in the 1980s with the GCC funded Iraq. Again, that's using the wealth to achieve economic or political goals. And most recently, we've seen the example of the UAE big investments in Egypt, which, yes, it has a commercial side, but it's also probably likely have a political dimension to it as well.
Mm-hmm. Ziad, thank you so much for a terrific briefing. As always, Ziad Daoud there, Chief Emerging Markets Economist at Bloomberg Economics, on his way to Doha, Qatar. Now, we'll have a host of big interviews coming here from the Qatar Economic Forum, including the Qatari Prime Minister, of course, the Saudi Finance Minister, and the HSBC Chief Executive, Noel Quinn. Coming up, we'll also look at earnings. We take a look at some of the earnings due this week, including major European telecom shares. Our previews next, and this is Bloomberg. Now, costs and capital spending cuts will be in focus when major European telecoms report this week. Now, analysts will also be watching luxury results after Burberry's profit warning back in January. So let's get more from all of this with Chloe Millet from Bloomberg. So, Chloe, what will investors' key focus in telecom earnings?
So the guiding metric here really is cash flow. Most of Europe's telecom companies have guided for a fairly optimistic baseline for cash flow growth for this year. So we'll see how that stacks up against what they actually report this week. They have been dealing with quite high input costs and wage pressures, so that might limit those cash flow goals. If we look specifically at some individual companies, BT is in the middle of a turnaround. It's trying to convince shareholders that it's worth expanding into consumer electronics, home security and gaming. So we'll see what the reaction is from the market in terms of any update to strategy. It is set to report a return to annual revenue growth after 6 years of decline, so it's fairly positive. For Deutsche Telekom and Vodafone, the focus is on shareholder returns. So Deutsche Telekom is set to have particularly strong cash flow despite wage increase demands from unions. And for Vodafone, it exited operations in Italy and Spain, so it has about 4 billion euros set aside for buybacks.
Thank you so much for the great roundup on telecoms. Chloe Millet there, of course, on some of the companies reporting later this week. Now, investors closely watching U.S. inflation data due on Wednesday. Bond traders on edge, as always, frankly, ahead of the highly anticipated CPI reading. Let's bring in Bloomberg's Ven Ram. Ven, thank you for joining us. I say as always, but actually, it feels like this week is really crunch time. Like, welcome to inflation week. What are you expecting?
Morning, Francine. I think that the markets are expecting that the headline print will come around 3.4%. Now, even if the headline print comes around there, the question is what kind of confidence is it going to inspire among the Fed committee? Because obviously that's not 2%. That's far away from the 2% that they had penciled in December and in March. So the Fed thinks that the PCE inflation, core PCE inflation, I beg your pardon, is going to come in at 2.6% this year. So far this year, it's been popping around 3%, more like it. So is it going to give the Fed enough confidence to cut rates? No. We heard from Michelle Baumann on Friday saying that they need a series of prints to convince them that inflation is on the mend. And unless we get that, a rally in treasuries is going to be elusive.
Then really quickly, are you worried? We had University of Michigan numbers. I mean, they weren't that great. Is there, is it possible that actually the rate hikes are catching up?
Well, I think that the policy works with a lag, and there's definitely some inkling in the economy that things are cooling. Momentum is we are fast losing momentum. But where is that point where which will be the inflection point for the Fed is the question. And at this point, the economy is doing fine. It's not doing as much as it was doing earlier last year, but it's not sufficient yet for the Fed to be decreasing rates. And the inflection point in terms of the economy will come when the jobless numbers start going above 4%, and we are nowhere near those levels yet.
Ven, thank you so much. As always, Ven Ram there from Bloomberg M Live in Dubai. Coming up, our interview of the week, Emmanuel Macron, the Président Français. That's coming up, of course, later this evening. This is Bloomberg.